forget buy low, sell high for just a moment. We often focus on what to buy or sell and when. But what if the actual mechanism you use to place that order? What if that is the subtle factor that introduces hidden costs, maybe leads to unexpected non-executions or, provides crucial automated protection?
That's a really important point. We're talking about the tools that can make your strategy work smoothly or, honestly, trip you up when the market suddenly gets wild.
Exactly. The order type you pick is, it's the critical interface between your idea and what actually happens in the live market.
Right. And overlooking the details here. That can mean leaving money on the table, facing risks you didn't plan for, or just, not executing your plan the way you intended.
So our mission today, diving into the material you've shared with us, is to get beyond the absolute basics, the simple market and limit orders everyone starts with.
We're going deeper into the powerful, sometimes kind of tricky world of stop orders, stop limit orders, trailing stops, and even OCO orders.
Yeah, we're going to unpack exactly how these things work, look at their power, maybe some potential pitfalls, and really see how they can be instrumental in protecting your capital or maybe helping you grab onto momentum when it appears.
And we'll be pulling insights from all sorts of places. You provided broker explanations, investor forums like Reddit threads, financial encyclopedias, the whole lot.
So you get a really well-rounded view, right? Not just definitions, but the practical side, the strategy behind using each order type.
Precisely. Okay, so where do we start? The foundation seems logical.
Definitely. Let's quickly touch on those two foundational order types first. You really need to get these before the others make sense. So the two simplest ways to get a trade done.
Right. The two most basic commands are the market order and the limit order. Think of them as sitting at opposite ends of a spectrum. It's all about speed versus price.
Okay, let's start with the market order. What's the core instruction here? What are you telling your broker?
A market order is basically the simplest thing. Buy or sell this stock immediately, right now, at whatever the best available price is at this exact moment.
Okay, so the big appeal is speed and execution certainty.
Exactly. Its main benefit and why people use it is that near certainty of getting filled.
Yeah.
Assuming there's, some liquidity, some buyers and sellers out there, your market order will almost always execute.
Certainty of execution sounds great, doesn't it? Especially if you're thinking, just get me in, or maybe get me out now. But there's a big downside, right?
There is, and it's critical to grasp this. The major drawback is the complete lack of price control. You're essentially saying, look, I don't really care what price I get, just execute this trade.
So the price you actually get filled at might be different from what you saw on your screen just a second before.
It might be, yeah. Sometimes significantly different. This difference between the price you expected and the price you actually got.
That's what we call slippage, isn't it?
That's it, exactly. Slippage is basically the price you pay for demanding that immediate execution. And it can happen in a couple of main ways.
Okay, what's the most common way?
The most common is probably bid-ask spread slippage.
Right. Can you quickly remind us what the bid and ask are and how they cause this slippage?
Sure. So for any stock at any given moment, the bid price is the highest price any buyer is currently willing to pay. The ask price is the lowest price any seller is currently willing to accept.
And the difference between those two is the spread.
Correct. Now, if you place a market buy order, your order automatically goes and finds the lowest ask price available and fills there. If you place a market sell order, it finds the highest bid price and fills there.
So let's say the last trade was at $9.
Yeah.
But the current bid is only $8, and the ask is way up at $10. If I hit market buy,
You're not getting $9. You're paying $10 the ask price instantly.
Wow.
And this came up in one of those Reddit discussions you shared. It's especially a problem for stocks that don't trade much or have low volume. That spread can be really wide. Like that $8 bid, $10 ask example. If you market buy, you pay $10. If you market sell, you get $8. Either way, you're immediately down compared to that $9 last price just because of the spread.
that spread slippage alone can be a significant cost, especially on less liquid things. Okay, what's the other type of slippage?
The other main one is time slippage. This can happen even in very liquid markets like those SPY options mentioned on Reddit, but it's worse when prices are moving really, really fast.
How does that work?
Well, you see a price quote on your screen. You click the button to place your market order. But in those milliseconds it takes for your order to travel to the exchange and get matched, the bid or ask price might have already changed.
So you might end up buying at a slightly higher ask or selling at a slightly lower bid than the price you saw just moments before you clicked.
Exactly. It's slippage due to the market moving between the moment you decide and the moment you execute.
Okay, so market orders. All about speed, guaranteed execution. But you give up control over the price. So when is this trade-off actually okay, or maybe even what you want?
Well, the sources highlight a few cases. If you're trading something incredibly liquid, like, say, shares of a huge company or very active ETFs where the bid-ask spread is maybe just a penny, the potential slippage is tiny, almost negligible.
Okay, high volume, tight spreads. Makes sense.
Yeah, and for some day traders, especially when a stock is moving decisively, getting in or out right now can be more important than squeezing out the absolute best price. Speed is paramount.
That get out now order type from the Reddit thread.
Exactly. When speed is the absolute #1 priority, above all else, a market order is your tool. For those emergency situations, maybe.
But generally speaking, for most people, or for stocks that aren't trading millions of shares a minute, that price uncertainty is a pretty big risk to take on.
It is. You're basically putting your trust in the market to give you a fair price at that very instant, and without specifying your limits, that can sometimes be a costly assumption.
Which brings us neatly to the other fundamental order type, the one designed specifically to control the price.
The limit order, yes. It's the direct opposite philosophy to the market order.
So what's the instruction with a limit order?
With a limit order, you tell your broker, I want to buy this stock, but only if I can get it at or below the specific price I'm setting. That's a buy limit. Or I want to sell this stock, but only if I can get at least this specific price or higher. That's a sell limit.
Okay, so if a stock's trading around $52, maybe bouncing around a bit, but I only want to buy it if it dips back down to $50, I'd place a buy limit order at $50.
Correct. And the huge advantage here is absolute price control. If that limit order executes, you are guaranteed to get your limit price, or potentially even better.
Or better. How does that happen?
Well, if you have a buy limit at $50 and the price drops quickly through $50 to, say, $49.95, your order might fill at $49.95. You still got filled at or below your limit. Same idea for a sell limit. You might get filled slightly above your minimum acceptable price. The guarantee is you won't get worse than your limit.
That price guarantee sounds fantastic compared to the uncertainty of a market order. What's the catch? There's always a catch.
The catch is the big one. No certainty of execution. Your order might simply never get filled.
Ah, so if I place that buy limit at $50 and the stock price rallies from $52 and never looks back, never drops to $50 or below.
Your order just sits there unfilled.
Yeah.
Eventually it might expire if it's a day order, or it could sit there indefinitely if it's good till canceled, but the trade never happens.
And you sometimes hear about getting skipped with limit orders. Is that part of this non-execution risk?
It is, yeah. Getting skipped often happens in really fast markets or when there are price gaps. Imagine your buy limit is at $50. The stock's trading just above it, maybe $50.50. Suddenly, there's great news, and the price instantly jumps from $50.50 straight up to $52. It never actually traded at $50.
So my order of $50 was just bypassed.
Exactly. It got skipped. Or maybe the price does touch $50 briefly, but there just aren't enough shares being offered for sale at $50 to fill everyone who had a buy limit order there. If liquidity is thin or the move is too sharp, your order might only get partially filled or not filled at all. The Reddit comments were right. Getting skipped depends a lot on market speed and how much stock is available at your price.
Okay, so limit orders are really essential when controlling the price is your absolute top priority, more important than just getting the trade done immediately.
Precisely. They can definitely save you money compared to market orders by preventing bad fills, and they're very commonly used for setting profit targets. You know, selling a stock you own when it hits your desired win-side price, as that one Reddit user put it nicely.
It's the tool for patience and price discipline, but you have to accept the risk that the market might just run away from your price and you miss the trade entirely.
That's the trade-off. Speed and certainty of execution with market orders versus price control but uncertainty of execution with limit orders.
Okay, foundation laid, market for speed, limit for price. Now let's build on that. What if you want an order that isn't active right away, but only sort of wakes up or gets triggered when a specific price level is actually reached?
Now we're moving into the conditional orders. This is where stop orders come in. They add that trigger element based on price movement.
A stop order. Okay, what's the fundamental thing that makes it a stop order? How does it work?
The absolute core mechanic, and this was stressed across multiple sources, Wikipedia, RBC, EBC, Investopedia, is that a stop order has a specific price you set, called the stop price.
Right.
When the market price of the stock touches or moves past that start price, the stop order is immediately triggered. And here's the crucial part. It then becomes a market order.
Ah, okay, that's really important. The stop price is just the trigger. It doesn't guarantee you'll get that price. It just flips the switch and turns your order into a live market order.
Exactly. That's the key detail. And it's the source of both their utility and one of their main risks, which we definitely need to talk about.
So where you place that stop price is critical, depending on what you're trying to achieve.
Absolutely. For a buy-stop order, you always set the stop price above the current market price.
Above. Why would you want to trigger a buy order only when the price goes up?
Good question. The EBC source laid out several reasons. You'd use a buy stop mainly to jump into a trade that's already showing strong upward momentum. It's a way to say, okay, the price is really moving, now I want in.
So buying into strength.
Exactly. Or confirming a breakout above a resistance level. Maybe a stock has struggled to get past $60 several times. You could place a buy stop at $60.50. You only buy if the price proves it can break through that ceiling.
It helps avoid jumping the gun on a move that might fail.
Right. It avoids premature entries. It automates your entry based on the price hitting a level that validates your thesis, especially if you can't watch the market tick by tick.
Okay, so buy stops are for entering on upward momentum or breakouts. Is that the same as using a stop to limit loss on a position you already own?
Not typically for entering a standard long position, no. However, buy stops are used, critically, to limit losses or protect profits if you are short selling a stock.
Ah, okay, explain that.
If you've sold a stock short, meaning you borrowed share and sold them, hoping the price will fall so you can buy them back cheaper, you're betting on the price going down, but what if it goes up instead? You'd place a buy-stop order above your short entry price.
Why above?
Because if the price starts rising unexpectedly, hitting that higher stop price triggers a market order to buy shares. This closes out or covers your short position, capping your potential loss on that short trade.
Got it. You're buying it back at a loss to prevent an even bigger loss if it keeps climbing. Okay, that makes sense for shorts. Now, the more common one people think of, the sell stop order. This is what most people mean when they say stop loss, right?
Yes, exactly. While stop loss is really describing the purpose or the strategy, the actual order type you use is typically the sell stop.
And this one is placed below the current market price.
Correct. Below the current price. And its overwhelming use case is to limit the potential loss on a stock you already own, what we call a long position.
So the classic example, I bought a stock at $100. I decide my maximum pain tolerance is $15 per share, so I place a sell stop order at $85.
That's the textbook use. If the stock price drops and hits $85, your sell stop order triggers instantly becomes a market order and sells your shares at the best available price around $85. It's your automated eject button.
Preventing further losses below that $85 level.
Right. And it can also be used to protect profits. Let's say you bought that stock at $50 and it's had a great run up to $120. You're happy but worried it might pull back.
So you can place a sell stop maybe at $100?
Exactly. Place a sell stop at $100. If the stock continues higher, fantastic. If it reverses and drops back to $100, your stop triggers, sells your shares, and you've locked in at least $50 per share of profit.
That's the automatic exit on the loss side, or in this case, the profit protection side that the Reddit commenter mentioned. It helps manage risk without you having to stare at the screen all day.
And this is a really crucial point mentioned in the sources. Using stop-loss orders is a powerful way to fight against common behavioral biases in investing,
Like what?
particularly the disposition effect. This is a well-documented psychological tendency where investors tend to sell their winning stocks too soon to lock in a small gain, but hold on to their losing stocks for far too long, hoping they'll somehow recover.
The it'll come back trap.
Exactly. A preset stop loss takes that emotional decision-making out of the equation when the stock is falling. It forces you to stick to your risk management plan. I will not lose more than X amount, even when your gut might be screaming to hold on just a little longer.
That behavioral angle is huge. It enforces discipline at exactly the moment discipline is hardest to maintain. But you mentioned a key risk earlier. With standard stop orders, once that stop price is hit, they become market orders. What does that mean for the actual price you get?
And this is the primary Achilles heel of the standard stop order slippage. Because it becomes a market order upon triggering, you're not guaranteed to get filled at your start price.
So back to my $85 sell stop example. If the stock price doesn't just drift down to $85, but maybe crashes through it because of bad news,
then the market order generated by your triggered stop might fill at $84 or $80, or in extreme panic situations, maybe even significantly lower. The $85 was just the trigger point. The actual execution price depends on the available bids after it triggers.
Wow. So you could intend to limit your loss to $15, but actually end up losing $20 or $25 or more per share in a really fast drop.
Absolutely. That is the critical risk. Your stop price defines when the sell instruction goes live, but not the price it executes at. The same applies in reverse for a buy stop in a rapidly rising market. Your triggered market buy order could fill at a much higher price than the stop level itself.
That's a major potential pain point. You think you're protected at a certain level, but in the worst market conditions, the protection might not be as solid as you thought.
Exactly. And there's another related risk, especially in choppy markets or for short-term traders, getting starved out by temporary triggers. People sometimes call these whipsaws or fake outs.
What happens there?
Imagine your sell stop is at $85. Maybe there's a sudden, brief dip, perhaps caused by a big institutional order hitting the market, or some algorithmic trading noise that pushes the price down to touch $84.95 for just a second.
It hits my stop.
It triggers your stop order, you get sold out via the resulting market order, and then, maybe just moments later, the price snaps right back up above $85 and continues on its merry way.
Oh, that's infuriating. You get shaken out by noise, take a loss, and then miss a recovery or the continued move up.
It's a classic frustrating scenario, and it's why setting stop levels isn't just about picking a number. It requires thinking about the stock's volatility and trying to place the stop outside the range of normal market noise.
And the sources also mentioned just setting and forgetting isn't always wise.
Right. While automation helps with emotion, these orders are purely price-driven. They don't react to news or context. A stop order will trigger if the price hits, regardless of why it hit. Also worth remembering, you can't always place stop orders on every single stock, especially very illiquid ones or those on certain OTC markets.
Okay, so standard stop orders. Powerful for triggering based on price, great for risk management discipline, but that market execution carries a significant risk of slippage, especially when you need it most. Is there a way to get the trigger mechanism but add price certainty back in?
Absolutely there is. And that brings us to the stop limit order. This order type was basically invented to address that exact slippage risk of the standard stop order.
Okay, stop limit. So it combines the stop trigger with a limit order's price control.
Precisely. When you place a stop limit order, you actually define two specific prices, a stop price and a limit price.
Two prices. Okay, how does that work differently when the stop price gets hit?
This is the crucial difference. With a standard stop, hitting the start price creates a market order. With a start limit order, when the market price reaches or passes your designated start price, the order is triggered, but it becomes a limit order at your specified limit price. It turns into a limit order, not a market order. Okay, let's walk through an example. Let's do a sell stop limit, like the one in the Gemini source material. Say I own a stock, it's trading at $60. I want protection if it drops, but I really don't want to sell below a certain floor.
Okay, so you might set your stop price at, say, $55. That's the trigger. When the stock price falls and hits $55, your stop limit order activates.
But it doesn't sell immediately at market.
No, because you also set a limit price. Let's say you set your limit price at $53. Once that $55 stop is triggered, your order transforms into a sell limit order with a price of $53.
So activated at $55, but it will only actually sell if the market price is $53 or higher.
That's exactly right. Your shares will only be sold if a buyer is willing to pay $53 or more after the $55 trigger occurred. It can fill anywhere between $55 and $53, maybe even slightly above $55 if the price bounces right after triggering. But the key guarantee is you will not sell for less than $53 per share. Okay, that seems like a massive improvement over the standard stop. You get the trigger, but you also get that price floor. Much more control over the minimum you'll receive.
It definitely offers that price control and precision, like RBC and Gemini pointed out. It gives you a say in the final transaction price after your initial condition, the stop price, is met.
So what's the downside? Why wouldn't everyone just use stop limits instead of regular stops?
Well, here's the trade-off, and it's the flip side of the price guarantee. You reintroduce the risk of non-execution.
The limit order problem comes back.
Exactly. Because the triggered order is now a limit order. If the market price moves too quickly or gaps down past your limit price after the stop price is hit, your order might not fill at all.
So back to the $55 stop, $53 limit example. If the stock hits $55, my order becomes a sell limit at $53. But if the price just instantly plummets from $55 straight down to $50,
completely skipping the price range between $55 and $53.
and my limit order at $53 never gets a chance to fill.
Precisely. It wouldn't execute because the market price never traded at or above $53 after the trigger. This risk is much higher in very volatile markets or when there are significant price gaps, like overnight or on major news events. Gemini's crypto example really highlighted this. Volatile assets can jump right over your limit.
So you have this delicate balance in setting the two prices. If you set the limit price really close to the stop price, like stop $55, limit $54.90, you're demanding a very good fill.
But you significantly increase the chance of not getting filled at all if the price is dropping fast.
Whereas if you set the limit price much lower, like stop $55, limit $50, you give it a much wider window to execute.
Increasing the odds of getting filled, but potentially accepting a much worse price than you might have wanted. You're basically defining the worst price you're willing to accept if the stop triggers.
So it really requires more thought and analysis to set those two prices effectively.
It does. It's not just picking a stop level. As the Gemini tip suggested, you need to consider the market conditions, the stock's typical volatility, maybe using something like ATR, the average true range, to gauge typical price swings and decide how much risk of non-execution you're willing to take versus how tight you want that price control to be.
RBC and FANRI basically summed it up.
Yeah.
Stop limits give you price certainty, but they risk non-execution. You use them when hitting your target price is more critical than guaranteeing you get the trade done right away.
It's a more nuanced tool, definitely. Adds control, but also adds another potential point of failure if things get really chaotic.
Okay, so we have standard stops triggering market orders, risk of slippage, and stop limits triggering limit orders, risk of non-execution. What about when things are going well? You've got a profitable trade and the price is moving nicely in your favor. Is there an order type that can automatically protect those rising profits?
Yes, absolutely. That's a perfect job for a trailing stop order. Think of it as a dynamic, self-adjusting stop loss designed specifically for winning trades.
Dynamic.
Yeah.
How does that work? It moves.
It does. Unlike a standard stop with a fixed price, a trailing stop's trigger price automatically adjusts, or trails, the market price upwards as the price moves favorably for you, assuming you're long, i.e. you own the stock.
So if I own a stock and the price goes up, my trailing stop price automatically moves up with it.
Exactly. You define the trail amount when you place the order. This can be a fixed dollar amount like $1 below the peak price, or more commonly a percentage like trail 5% below the peak price.
Okay, so how does it adjust?
Let's say you bought at $50 and set a 10% trailing stop. Initially, the stop is 10% below $50, so $45. Now the price rises to $60. Your trailing stop automatically recalculates 10% below $60 is $54, so your stop moves up to $54.
It keeps that 10% distance from the highest price reached so far.
Correct. If the price then climbs to $70, your stop moves up to $63, 10% below $70. Now here's the key. If the price then starts to fall from that $70 peak, the trailing stop price stays fixed at $63. It only moves up. It never moves down.
So it locks in that highest stop level achieved.
Precisely. And if the price continues to fall and eventually hits that $63 stop level,
Then it triggers.
just like a standard stop order. It becomes a market order to sell your shares.
I see. The goal, as Investopedia put it, is to let your profits run, but automatically tighten the safety net underneath them as they do.
Yeah.
It limits the downside if the trend reverses, but avoids choking off a winning trade too early.
It automates that process beautifully. Investopedia had that great example. Buy at $10, set a $1 trailing stop. Initial stop, $9. Price goes to $12. Stop trails to $11. Price hits $15. Stop trails to $14. Price peaks at $15, falls back. Stop stays locked at $14. Price hits $14. Boom, market sell order triggers. You're out with a profit captured near $14.
That's incredibly useful for trend-following strategies or just managing winners without having to manually adjust your stop loss every day.
Absolutely. It takes a lot of the guesswork and emotion out of managing profitable positions. Investopedia also mentioned you can set the trail based on different things, not just fixed dollars or percent, but sometimes based on volatility measures like ATR, or even technical levels like moving averages or support points.
So the main advantages seem clear. Locking in profits while letting winners run, reducing emotional decision-making about when to sell.
Yes, automating risk management on the upside. They're particularly well-suited for markets that are showing clear trends.
It sounds fantastic. What are the potential drawbacks or things to watch out for?
Well, like setting any stop, there's a bit of a learning curve in choosing the right trailing distance. Set it too tight, say, a tiny percentage trail and normal market volatility, just the everyday up and down jiggles, could prematurely trigger your stop.
Get stopped out by noise again, even though the main trend might still be intact.
Exactly. You need to set a distance that gives the stock room to breathe based on its typical volatility, but not so wide that you give back an unacceptable amount of profit when it finally does reverse. Investopedia also noted they're generally less effective in sideways or choppy markets where prices aren't really trending but just bouncing around a range. You might get stopped out repeatedly.
And critically, when the trailing stop does trigger, it functions like a standard stop.
Right.
It becomes a market order.
That's the standard mechanism, yes. So the risk of slippage on the actual execution is still there, just like with a regular stop order, especially if the price drops very sharply through your trailing stop level.
Though I suppose, similar to regular stops, some brokers might offer a trailing stop limit version?
They might, yes. That would trigger a limit order instead of a market order when the trail is hit, giving you price control. But again, bringing back that risk of non-execution if the drop is too fast and gaps past your limit. It's always that trade-off.
Okay, this is great. We've covered stops that trigger markets, stop limits that trigger limits, and trailing stops that move. What if you're facing a situation with two distinct possibilities and you want to set up orders for both, but ensure only one of them actually happens?
Now you're describing the perfect scenario for a one cancels the other order, usually abbreviated as OCO.
OCO. The name is pretty self-explanatory.
It really is. An OCO order works by linking a pair of conditional orders together. The defining feature, stressed by both Investopedia and Wikipedia, is that if one of the linked orders executes, the system automatically cancels the other order in the pair.
So they're mutually exclusive. If A happens, B gets canceled. If B happens, A gets canceled.
Exactly.
And what's the most typical pairing of orders you see in an OCO?
By far, the most common combination is linking a stop order and a limit order together.
Okay, when would you use that specific combo?
The classic use case is managing an existing position where you want to define both your profit target and your maximum acceptable loss simultaneously.
Can you walk through an example?
Sure, Investopedia had a good one. Let's say you own 1,000 shares of some volatile stock you bought at $10. You have two goals. One, you want to sell and take profits if the price climbs up to $13. Two, you want to cut your losses if the price falls down to $8.
Okay, profit target $13, stop loss $8.
Right. You can place a single OCO order that contains both. A sell limit order at $13 and a sell stop order at $8.
So what happens if the stock price goes up and hits $13?
Your sell limit order at $13 executes, you sell your shares for a profit, and crucially, the moment that limit order fills, the OCO link automatically cancels the sell stop order you had sitting down at $8.
It cleans up after itself. And if instead the stock price drops and hits $8?
Then the sell stop order at $8 triggers. It becomes a market order, usually. Your shares are sold near $8 to limit your loss, and the OCO link automatically cancels the still pending sell limit order up at $13.
That automatic cancellation is huge, because if you just place those two orders separately, a limit at $13, a stop at $8, and the $13 limit filled,
that $8 stop order would still be live. If the stock, for whatever reason, later dropped back down to $8, that old stop order could trigger and cause an unwanted trade, maybe even shorting your account if you didn't own the shares anymore.
Right. The OCO prevents those potentially problematic orphan orders hanging around after one side of your plan is already executed. It keeps things tidy.
Exactly. It ensures that reaching either your profit goal or your loss limit concludes that specific trade setup.
Can you use OCOs for getting into trades too, not just managing existing ones?
Yes, you can. Investopedia mentioned using them for trading breakouts or breakdowns. For example, imagine a stock is stuck trading sideways in a range, say between $20 and $22. You're not sure which way it will break, but you think when it does, it'll be a significant move.
So you want to buy if it breaks above $22, or maybe short it if it breaks below $20.
Right. You could place an OCO order consisting of a buy stop order just above the $22 resistance level, say $22.50, and a sell stop order just below the $20 support level, say $19.50.
Okay, so if the price pushes up through $22 and hits the $22.50, buy stop.
That buy stop triggers becomes a market order, and you buy shares to enter a long position, hoping the upward breakout continues. And simultaneously, the OCO link automatically cancels the sell cert order you had down at $19.50.
That's pretty neat. It lets you bracket a consolidating market and automatically jump in whichever direction it breaks.
It does. It's useful for those either entry scenarios in volatile or consolidating markets. However, there's a really important point to remember if you use OCOs for entry.
What's that?
The OCO order only manages those two potential entry orders. Once one of them executes, say, the buy stop at $22.50 fills, and you now own the stock, the OCO's job is done. It canceled the other entry order. But it does not automatically place a protective stop loss order for the position you just entered.
That's critical. So once my buy stop at $22.50 fills, I'm long the stock, but I have no stop loss in place yet.
Correct. You would then need to manually place a separate sell stop, or sell stop limit, order to protect that new long position. The OCO just handled getting you in. It doesn't handle the risk management after entry.
That's a very easy mistake to make if you're not aware of it. You think the OCO has you covered both ways, but it only covers the entry choice.
It's a crucial operational detail. And just briefly, while we're talking related concepts, you might sometimes see OSO orders one sends other. Unlike OCO, which cancels the other order, an OSO order sends or activates a new secondary order after the primary one executes.
So like if my buy limit at $50 fills, then automatically place my sell limit profit target at $60 and my sell stop loss at $45.
Exactly. OSO is about sequential actions triggered by the first order. OCO is about mutually exclusive choices where one cancels the other.
Got it. OCO is A or B cancel the other. OSO is if A, then do B and maybe C.
Perfect summary.
Wow. Okay. We have definitely gone deep today. From the basic market and limit orders through standard stops, stop limits, the dynamic trailing stops, and these linked OCO orders. Let's try and bring this all together. Looking back, what are the big recurring risks we kept seeing?
Yeah, pulling it together, the fundamental risks really boil down to slippage, which is the price difference risk that's most prominent with market orders, and any stop order that triggers a market execution, especially when things are moving fast or spreads are wide.
Right.
Then there's the risk of non-execution. That's the core challenge with limit orders and start limit orders. You get price control, but you might miss the trade entirely if your price isn't met or is skipped over.
And the third one?
The potential for temporary triggers or those whipsaws or fake outs where short-term price noise hits your stop level prematurely, stopping you out just before the price reverses back in your favor.
And it seems crystal clear from all the sources in our discussion that there's no single best order type, is there? It's not like one is always superior.
Not at all. They're tools in a toolbox. And like any tool, whether it's the right one depends entirely on the job at hand.
So what defines the job? What factors determine which order type is appropriate?
I think it boils down to three main things. First, the market itself. How liquid is the stock? How volatile is it right now? Is it in a clear trend or just chopping sideways? Second, your specific goal for this particular trade. Are you prioritizing getting it done now above all else, or is getting a specific price more important? Are you trying to enter, take a profit, or cut a loss?
And the third factor?
Your overall strategy. Are you a scalper trying to make pennies in seconds, a swing trader holding for days or weeks, or a long-term investor adjusting a position? The right tool depends heavily on that strategic context.
So a market order might be perfectly fine, even necessary for a day trader scalping highly liquid SPY options, because speed is everything and slippage is minimal.
Right. But using that same market order on a thinly traded penny stock could be disastrous due to a massive bid-ask spread. And using a standard stop order on that same illiquid stock during volatile news could lead to horrific slippage when triggered.
Conversely, stubbornly using only limit orders in a powerful, fast-moving trend might mean you just watch the train leave the station without you, never getting filled.
Or using a trailing stop in a market that's just bouncing around sideways could lead to getting constantly nickeled and dimed as you're stopped out on minor fluctuations again and again.
This really underscores how important analysis is, not just in deciding what to trade, but in deciding how to trade it, and specifically where to place those price levels for stops and limits.
Absolutely critical. Setting intelligent stop prices, limit prices, trailing distances. It isn't just pulling numbers out of thin air. It should ideally involve understanding the specific stock's typical volatility, maybe using tools like ATR, identifying real support and resistance levels on a chart, and considering the recent price action.
Like Investopedia said about stop losses, there's no magic percentage that works for everything. It has to be tailored.
Tailored to the stock's personality and your trading style and risk tolerance, exactly.
And the final piece we touched on was the emotional side. These automated orders are often pitched as a way to take emotion out of trading.
And they can be incredibly helpful for that, as sources like EBC and Investopedia highlighted. By setting your exit rules based on analysis before you're in the heat of the moment, watching your money fluctuate, these orders help you stick to your plan mechanically.
fighting that disposition effect we talked about.
Precisely. They enforce discipline. But the caveat from EBC was also important. Relying purely on automation without any context or oversight can be risky too. What if major news breaks that completely changes the game? Your stop order doesn't know or care, it just executes based on price.
So it's not about blindly trusting the automation, but using these sophisticated orders as disciplined tools to implement a plan you've already thought through carefully.
That's the key. They are powerful parts of a risk management framework. They structure your interaction with the market. But they need to be used thoughtfully, with an understanding of their strengths and weaknesses in different market conditions. Think of them like an insurance policy. Maybe you hope your stop loss never gets hit, but you put it there just in case the unexpected happens.
That's been a really comprehensive deep dive today.
I
You've
think
gone way beyond just buy and sell, exploring stop orders triggered by price, stop limits adding price control, trailing stops that dynamically protect profits, and OCOs managing multiple scenarios.
And the recurring theme is that trade-off between execution certainty and price control, manifesting as the risks of slippage versus non-execution. Choosing the right order means understanding which side of that trade-off you need to prioritize for that specific situation.
So the key takeaway isn't just memorizing definitions, it's about understanding the practical consequences, right? Mastering that balance, using analysis to set smart levels, and leveraging the automation these orders provide to enforce discipline and manage risk as part of a coherent strategy.
Exactly. These are essential tools if you want to navigate the markets with more precision, more control, and hopefully less emotional stress.
It really makes you wonder, though, if these automated orders are so effective at removing the raw, in-the-moment emotion, how much of trading success is about finding the absolute perfect analytical edge versus just having the psychological fortitude to create a solid plan beforehand and then letting these tools execute it without interference?
That's probably the million-dollar question in trading psychology, isn't it? The tools help execute the plan, but the human mind still has to create the plan and trust the tools.
Food for thought, definitely. Well, that wraps up our deep dive for today. We really hope exploring these advanced order types has given you, our listeners, a much clearer picture and some practical ideas you can apply to your own approach in the markets.
Thanks for tuning in.